Hello, I'm Julian Whittle from Cumbria Chamber of Commerce, and I'm here with David Finan, a chartered financial planner and managing director of the financial advice firm Jardine Finan. And we're going to discuss pensions, specifically pensions for the self-employed. Now, David, a report has just come out. It's from IPSI, the Association of Independent Professionals and the Self-Employed. And it flags up a potential problem. There are around 4.8 million self-employed people in the UK, and that number's growing. But less than a third of them, 31% in actual fact, are paying into a pension scheme. Now, for employees, the proportion is way, way higher, 73%. So why do you think the take-up of pensions by the self-employed is so low?
Well, first of all, the high take-up of employees is largely due to auto-enrolment.
Yeah.
Before that came, it was a lower figure. But with the self-employed, there's a variety of reasons. Many believe that the business is their pension, and then investment into the business is under their control, and benefits from the business are perhaps seen to be more flexibly accessed. It is a risk. There are some very good businesses. Well, I must say, that works very well for a lot of people. And it's not a criticism that people might take that view. But there is risk associated. There are a lot of very good businesses who, which when come to the sale of that business, don't fetch the figure hoped for through no fault of their own. I mean, one case I know of, a very successful filling station, for many years was the pension, and then a few years, very short few years before retirement, there was a new road bypassed the filling station.
Right, the tree dropped off.
It drastically fell back, which obviously reduced income, but more importantly, it devalued the business. And it was no longer going to be the source of retirement income selling it. And there are lots of other cases like that. Through no fault of the individual, their business might not fetch what they'd hoped for. So in a sense, you could say it's all the eggs in one basket, whereas a pension, a lot of people see the pension as really a subsidiary company, which is working 24 hours a day for them without any physical input. But there are other reasons. Affordability obviously is one. New businesses usually require significant capital with little or no free cash for long-term savings. And of course, a business must be profitable before you benefit from the tax incentives associated with funding a pension. If there's no profit, then there isn't going to be any tax benefit.
Well, we'll come on to that in a tick. But let's look at the scenario then. For someone, a self-employed person who hasn't got a personal pension or a SIP, the government has brought in, that it's tweaked the state pension. There's now a flat rate or single tier state pension, which the government calls the new state pension. If someone were to retire solely reliant on the new state pension, what sort of income could they expect?
£164.35 a week.
It's about 8,000 a year, isn't it?
About 8,500. And it's paid for weekly in arrears. And it is dependent on the national insurance record. You require 35 qualifying years for that full figure, 164. But even if you haven't got the full 35 years, in order to get any kind of reduced pension, you'd need at least 10 years of national insurance. So it's not a lot, and I think most people who've enjoyed the benefits of being self-employed
would want to
certainly couldn't live or maintain any kind of lifestyle on the state pension.
I can quite see that. And now that report I referred to, the IPSI report, highlights that younger people, millennials if you like, are the self-employed group that are least likely to be paying into a pension, presumably because retirement seems a long way off to them, and it doesn't appear to be a priority. But we heard this time and again from pensions professionals, starting early makes a huge difference to your income in retirement, doesn't it?
Absolutely, a huge difference. But I do have sympathy for young people. They have demanding conflicts that very often got mortgages, there's children, that could be repaying student loans. So budgeting is very often very difficult for the young. But I can give a few examples of what the difference makes.
Yes.
If we take a 25-year-old retiring at 67 and requiring an income of, say, 25,000 a year, then in today's money, that's going to require a fund of about 458,000. The level of contribution necessary to create that fund, assuming only a modest 5% growth, is something like £650 a month.
Oh, that's starting at 25.
That's starting at 25. With the same requirements, the same income of 25,000 a year, the funding he would need to make to produce the fund capable of providing that pension moves up to about £920.
At what age?
At 35.
At 35.
Yes. So 10 years on, and it moves from the figure I've said, about 650 a month, up to 920.
Yeah, so 50% more roughly. Yeah,
a significant increase for the sake of those 10 years.
10 years, yeah.
Now, there's a lot of assumptions being made there. The assumption that of growth rates is probably a very big assumption. It could be a lot higher than that, but equally, there are some funds which might fail to achieve that. It's unknown. None of us knows what future rate of inflation we're going to live through, and if we do get inflation taken off and income requirements rise, we've got to assume income rises, and therefore affordability will go up with it.
And that's assuming as well, presumably, that they buy an annuity on retirement, is it?
Well, that is an assumption, which in reality very, very few people today would be buying an annuity, because as interest rates have fallen over the last 10 years, so have annuity rates. Of course, it must be understood that when you buy an annuity, it's a one-off transaction. You can't reverse it.
Yeah, you can't pass it on. Your pension fund. Yeah.
Well, there's no fund. The fund has
handed
disappeared.
it over, haven't you?
Annuity is buying an income. For those perhaps are not quite clear about it, you've created a fund during your lifetime. If you're buying an annuity, that fund disappears to buy the income. That's what you're doing when you buy an annuity. You're buying an income. And today you're buying at all-time record lows, which can't be reversed. So if we do get inflation taken off, and there is a requirement for a higher income, the annuity won't provide it. It's true that some annuities are
escalating,
linked, but they have such a small starting figure that, again, very, very few people would contemplate doing it. But luckily, buying an annuity there are alternatives to it, and have been alternatives for a very long time now. I don't know if we've got the time to discuss that, but the alternative is going into drawdown, where the fund doesn't disappear buying an income. It remains an investment fund, an investment portfolio, from which you draw whatever the sum is you require.
But the difference is, of course, with an annuity, you are guaranteed the income for life, whereas with a drawdown, if you're touching your capital, then you could run out of money.
That's exactly right. With an annuity, for all the disadvantages it has, you are buying certainty. And for someone who's extremely risk averse, then you have got the certainty of a certain level of income. The risk, of course, is that it's not going to be a high enough income. It's not taking care of inflation for you. And that's a very real risk. With drawdown, the risk is that you withdraw more than the fund's capable of sustaining. But that requires careful monitoring, and it requires ongoing financial advice.
Okay. Coming back to the issue particularly of the self-employed, in comparison with an employee, when an employee joins a workplace pension scheme, obviously their employer contributes to it. That doesn't apply if you're self-employed. But there are, you touched on this earlier, there are still good tax reasons for a self-employed person to pay into a personal pension, aren't there?
Yes, the contribution qualifies for tax relief. If you are self-employed rather than operating as a company, then you would make that contribution the same way as an employee would make, and that's net of basic rates of tax. So in other words, £800 going in finds the Inland Revenue adding £200 to it.
If you're a basic rate?
Well, regardless of the rate of tax paid, that's what happens initially. You pay it net of basic rates of tax.
Right.
So it immediately grows from £800 to £1,000. There isn't any other form of investment guarantees that.
So do that, no.
But following the contribution, it's then allowed to grow and accumulate exempt of tax. At the time you decide to take benefits from the fund you've created, you can take 25% of the fund as a tax-free lump sum. So that's a bundle of tax benefits which doesn't exist for any other form of long-term saving. If you're a higher rate taxpayer, there's a further 20% you're going to be able to claim on that £1,000 of gross contribution. So effectively, it's been £600 of your money has created £1,000 worth of investment. So that's a very real incentive to do it. If you operate as a company, then you're an employee, and it means the company could be making a pension contribution for you.
Well, you'd of course then come under auto-enrolment, wouldn't you, if you were an employee?
Well, you might choose to, but there's an alternative to it.
Yeah.
But certainly a company making a contribution, it's the benefit there is that it benefits from corporation tax relief.
Yeah.
And it means that, well, it's often said the only legal way you can take a benefit from your own company without being subject to tax of some sort at some stage is a pension contribution from your own company. Because you're not taxed in any way for the benefit you're getting. There's no national insurance contributions paid by either yourself or the company. And you benefit from less corporation tax and the tax exemption on its growth, etc.
So some powerful tax reasons then for investing in a pension. Now, you mentioned this earlier, that there may be one reason that the take-up of pensions by self-employed is low is because they actually consider the business to be the pension and they plan to sell it when they retire. Obviously, there's that danger that it might, for whatever reason, it might not realise what they hope. Or maybe they're looking at other investment strategies like building up a portfolio of buy-to-let properties to give them an income in retirement, or investing in ISAs, individual savings accounts, rather than a pension, because obviously it's more flexible and you can get that money before retirement if you needed to. So there are these alternative strategies, if you like, to a pension. What are the potential drawbacks?
Well, you're quite right to say that the benefits can be obtained sooner with an ISA. With a pension, currently you've got to be at least 55. There's no restriction on what you take out. But of course the disadvantage is you're not given tax, you're not benefiting from tax relief on the money that goes into the ISA. So in other words, you've had to either produce a profit, if in the case of the self-employed, pay tax on that profit before you end up with a net figure, and it's that net figure going into the ISA. It's not to say that that's not a useful means of saving for a future retirement income, but I don't believe it should replace. It should be an alternative. It's an additional rather than alternative.
Yeah. So what you need is a strategy with different.
Yes. And in terms of buy-to-let property, again, that has worked, and I'm sure it'll continue to work very well for some people. But there are risks attached. Again, it's a single asset class you're investing in, property, which we all know has performed very well, but there's no guarantee it'll continue to do so. And in the case of rented property, there's a number of potential hazards. Void periods is probably the biggest one. Insurance, maintenance, and so on. It's no longer benefits from tax relief on the money you borrowed to buy the property. And when you take all those factors into account, the actual yield you're getting, people would be staggered very often.
It's not as good as it looks. No,
it's. I think you're doing very well if you're clearing 3%.
Right. Okay. The Taylor Review of Modern Working Practices, which came out last year, actually proposed a new pension system, or a pension system for the self-employed, along similar lines to auto-enrolment for employees. Have you any idea how that would work?
Well, it's not clear at all how it would work. Certainly no one's come out with a simple process of how it would work. Certainly not if it was compulsion. And if it's not compulsion, then we already have the solution, and that's a self-invested personal pension. The only guess I could make is that they would do it perhaps by adjusting rates of national insurance, which are paid.
I see.
But
Yes,
that's just a
speculation.
guess.
Yeah. No, it puzzled us at the time it came out. Actually. Anyway, many businesses have met their auto-enrolment obligations through Nest, which is the government's workplace pension scheme. Now, the self-employed can join Nest too, can't they?
They can.
Is it worth considering?
If they're operating as sole trader, self-employed status, if they're operating as a company, and many people regard themselves as self-employed when technically we know they're not, they're employees of the company. But if you view that category of people as self-employed and they employ people, then in fact it's not available to them.
I'm with you. Okay. Finally, if a self-employed person is listening to this podcast thinking, well, I haven't got a pension, maybe it's about time I did, what can they do? Where can they get information and advice?
There's a number of websites. The one which has been around for many years is called Unbiased.
That's the IFA's one, is it?
Yes. And a more recent one is Vouched For, which follows the model of TripAdvisor, if you're familiar with it, only it's for the world of financial advice. So clients report their experience and rate their advisor, and it's not something the advisor can choose to delete or amend in any way. What's said is said, and it's there for others to view. So those are websites available. But if you know of a local IFA, and I think it should be an independent financial advisor rather than a restricted advisor, then I'm sure they can help. It would preferably if they're chartered financial planners, but that's not always possible where you live.
Okay, excellent. Thanks very much, David.
Okay.